Hello everyone. Welcome to a example for a rental activity and the complications that go along with that. So I have set up some information about a rental property that a client might own. Um, and so we have a situation where the rental income is 7,500, and these are the total expenses. The days that were used for rental, that we rented it out at fair value and wasn't for a family, and the personal days we utilized this property. So this is, and remember, the chapter describes three basically cutoffs. You can have very little rental, less than 2 weeks, and then it's just personal property, and you can ignore the income and the expenses for the rental part. Or it can be mostly rental and only a little bit of personal, and then you just treat it as a rental. Because if your personal use is less than 10% or 14 days, then you can just treat it like any rental, and you don't have to worry about allocating or any of those types of things. But perhaps the most complicated one is where there is a mix, and this is probably happens more than it has in the past with the proliferation of Airbnb type of scenarios. So this comes up quite often. There's still some personal use or significant personal use of a vacation property. Now, if you just rent it, this is a rental 365 days, or the only time there's just a house down the street that you rent out, the second house, then you're not. It's just a rental property. But this is the situation where you rent it out sometimes, and then you use it, say at the beach or something like that. So total of 128 20 days. So this is in between. So those two extremes, significant personal use and significant rental income. Here's our income and the expenses in total. Notice that rental properties are depreciated, fall under what we learned about depreciation for under in chapter 6. But notice that typically your real estate is what is being depreciated, and for residential real estate, it's 27 and a half years. So that's why I've taken the cost divided by 27 and a half. I'm going to assume that we're well into the useful life. This isn't just a brand new property, so I don't have to worry about how many months or what time of the year it was bought. It's just a nice straight line amount of depreciation. Now, I will tell you that you can depreciate other pieces of in the house, like furniture, appliances that you may provide to your renter separately than the real estate. So you could have those, and they would have much shorter and different depreciation lives than the real estate. But we're going to simplify this and look at it as just the real estate. Remember, this is absent any cost for the land, which is sometimes a little tricky as to how much to separate out for land when you have a property that you purchase for one price. Obviously, they don't charge you separately. So first thing, now that we've determined kind of where this classifies, we need to calculate how much of each of these expenses gets allocated to rental and how much for personal. So we're going to take the number of days for rental divided by 120, and we're going to multiply that by the repairs and get the amount for each one of those. For utilities as well. So that's how much is going to be for rental and for repairs and for utilities. Now, according to the tax court, you can use a different allocation, and you can use the number of days divided by 365, and then the rest of it is going to be a deduction, could be a deduction on the Schedule A for property taxes. So that could be an itemized deduction. Now that's only going to benefit a taxpayer if they itemize. So as we learn about itemized deductions, those are less important than they used to be because of the higher standard deduction. But that could benefit them more by giving them a higher standard itemized deduction. Now that only applies to, the taxes and interest, not to the other expenses. So they do it based on the days compared to the total days utilized. This only was allowed by the tax court on the taxes and interest. And depreciation, you're back to the same thing as we did on the utilities and repairs. Now here's why that's important. Under the rules, if it is a mixed property like this, where it has both personal and significant rental use, you cannot have more expenses than you have rental income. So when we add these up, we see that our total expenses is higher than our rental income. So the most expenses we can take is $7,500. You will always reduce the amount of depreciation first, okay? So the order you take the deductions is basically what the tax law says. You take first taxes and interest, then the repairs and utilities, and last depreciation. So what we would do is reduce the amount of depreciation we would take to get this to be exactly $7,500. Okay, so we would subtract out 1321. I can just see that. So now we have expenses of $7,500. Now the personal part of repairs and the personal part of utilities and the personal part of depreciation doesn't go anywhere, doesn't have any effect on the tax return elsewhere, okay? But the personal part of the taxes and interest can go on the Schedule A. So because you might have expenses higher than the income, you want to reduce these taxes and interest as much as possible, given the tax court. That's why this tax court method exists, is because the taxpayer went to the court and proved, got the tax court to agree with them. That made that personal part that goes on their Schedule A is higher. Now, if we were to go down here under the IRS method, the repairs would be the same, utilities would be the same, okay? Depreciation would be, the original calculation would be the same, okay? But we would use the same allocation for the taxes and interest as we did for repairs and utilities. This is the way the IRS believes it should be done. They have not agreed to the tax court's method, but many people utilize it knowing that if they got challenged on it, they could went to the tax court would agree with them. All right. So again, like you said, like it was before, this is more than you can have because you can only have 7,500, right? Because it can't be a loss. So you would have to subtract from here the depreciation again, 29.24. Whoops, not enough. 34.24. There we go. So that would give us 0. And usually on the Schedule E, typically what we do is just reduce the depreciation on line 18 so that you get exactly 0. Total expenses equals total income. The rest of that depreciation can carry forward to future years if this was happened to be just a really bad year, but often it's not going to do much good. Now, see, this reduction, when you have this personal use, means that it really doesn't matter about the special $25,000 deduction, because that would only come into play if you didn't have personal use that made this, it was the minimal personal use, it was just a rental. You had a loss, which is allowed, but you had no other passive income to offset. So if you have a rental loss, and it's a regular rental, not one that has significant personal use like this one, then you can have a loss, but only to the effect that you have other passive income, other rentals perhaps. But if that is not the case and your income is under $150,000, you can also utilize some of that loss, up to $25,000, if it's on residential real estate, not commercial real estate, residential real estate, and take that $25,000, actually just any type of real estate, I'm sorry, real estate loss, but that phases out over between $100,000 and $150,000 as described in your textbook. So lots of restrictions on how to take losses, and you can tell by all these restrictions that what happened in the past is people took advantage, or took, you might say, tried to take losses that really didn't happen, or create losses that are look worse than they really were, in order to get deductions against their regular income. And so that's why there's so many rules about what this is. So you can almost always guarantee that if there's lots of specific rules, someone was trying to take advantage or do things that didn't look right, and so they came down and they wrote it specifically into the law as to what they could and couldn't do.